Stocks down 2 days in a row, which isn't surprising some strategists, including our next guest. He says the pullback is not unexpected since the S&P 500 has rallied more than 60% from its March lows. James Swanson is the chief investment strategist at MFS Investment Management, which has $175 billion under management. He joins us now from Boston. James, thanks for coming on the show.
Hi, Matt.
Let me ask you about your outlook for stocks here going forward. I mean, this pullback doesn't surprise you, but you do think it's short term, right?
I do. I think long-term investors are actually probably relieved because history tells us when you have these huge bounces from a severe market downturn that they're usually not unrelenting. You usually have 10–15% pullbacks. We haven't really had that, so people are probably waiting for it. It looks like it might be happening. It's probably a chance for long-term investors to get back in.
I mean, we've really, James, seen this kind of trend. I'm just looking back to August. We had a run up, we pulled back, we ran up again, we pulled back. We've done this several times over and over. So this is a healthy trend line in your view.
It's very healthy because the underlying fundamentals haven't changed. And remember what drives PEs. What drives PEs is growth and earnings. And we certainly have had enough evidence from every single sector that earnings are strong. Margins have held up amazingly well, even though these companies have been battered by a recession. And interest rates. We see interest rates across the curve falling today. We're in a sweet spot. Rates are low. Inflation risks seem to be subdued, and you've got this surprising earnings story out of virtually every sector. So the fundamentals haven't changed, and long-term investors ought to keep the faith here.
But, James, let me ask you, with those earnings, so much of that improvement in earnings has been the result of cost cuts. The job reductions, just really kind of cutting every and any cost that they can at corporate America. I mean, that's kind of run out of steam. So now what for earnings?
Well, now what? What these recessions tend to do, and it's really amazing when you go back through history, they tend to blow through these economies and create more affordability everywhere. Let's just take cars. Cars are now cheaper than they've ever been in terms of number of weeks it takes the average worker to buy a car. I think it's 21.6 weeks. People are going to buy cars because the average age of a car in the U.S. is 9.5 years now.
Wait. If you have a job.
If you have a job. But 95% of the people who had a job a year ago are still working, and their wages have risen 3% in this whole continuing period we've seen. Labor will come back. I know they were upset in Congress. I heard that excerpt before. But this is typical. Labor lags the market. And Tom Lee at J.P. Morgan points out when you hit new highs in GDP per worker, labor improvement follows 4 months later. That's historically been the case, and we just hit 120,000 of GDP per worker. It's coming. The labor markets are going to get better. They always lag these episodes.
James, let me ask you about the value here. I don't know if you saw a very interesting analysis in the New York Times on Monday showing a 10-year look at earnings. PE ratios now, with you take a look at 10-year trailing earnings, around 18.9, and the average is really closer to 16. So it's not really cheap right now, is it?
Yeah, but you mentioned a key thing, and I agree with you. That's an important metric, is trailing earnings. But the last 4 quarters were one of the worst in history for earnings. It was the worst recession, as far as the government tells us, since the Depression. And markets are moving forward. They're looking ahead. So you have a trough in earnings, market looking ahead. I would scrap that analysis at this particular point and do a trend line of earnings.
It is a 10-year look. It's not just, the last 4 quarters or 8 or 12 or 16.
It's a 10-year look, but what you need to do is smooth out the cycle, because trailing earnings just doesn't work in a cycle where you're at the bottom of earnings and the market knows they've got to go higher. If you look at a Graham and Dodd approach, which is a fundamental sort of look at mid-cycle earnings, you're going to find the average PE 20, and we're at about 17, 18. Not in bubble stage by any means, and I don't think overvalued.
All right, so given your outlook, given your scenario here, James, where do you think investors should be putting money? I think technology is one group you like, and one group that's really getting beaten up today, especially the chip names. So what is it about technology, and what specifically?
Well, investors should know a couple of things, and I think this is amazing. First of all, tech has both growth and value in it. Secondly, margins. Look at the tech sector. 2003, which was a similar period to now coming out of recession, tech margins were 7%. Today, they're double that. This sector is coining cash. The outlook is very internationally oriented. Their PEs are not high by historic standards, generating tons of cash, great balance sheets, and 3 product revolutions going on while we speak.
So even though the stocks is down about 3.3% today, you'd see that as a buying opportunity. Just got 10 seconds here.
Yes, the U.S. is amazingly good at one thing, and that is tech, and that sector is not in a bubble stage.
All right, we're going to leave it there. James, thanks so much. James Swanson joining us on this Thursday.